Hello, good morning to all. Welcome to today's Daily Dose of Market Insights by OANDA, presented by myself, Kelvin Wong, the Senior Market Analyst of OANDA Asia Pacific. So, very good morning to all. Today is a brand new week, Monday, 16th of October. So, before we start our Daily Dose of Market Insights, let's take a look at the disclaimer slides first. All right, this leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposit. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. All right, any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product, and this advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we start our daily dose of market insight, this will be the usual 3 key takeaways. So I will cover what took shape on last Friday in terms of the events, the highlights. Events will be, we talk about, it could be related to geopolitical, it could be related to earnings announcement from the US, and as well as key economic data that has an impact on the broader asset market classes, and as well as what are the events or data to look out for today, if there's any. And lastly, to round out will be the short-term technical outlook on the various asset classes that I will share with you across from the FX, the benchmark stock indices, and as well as the commodities market. All right, so let us start what happened on last Friday. So as you all know that last Friday, we start to see another round of risk-off event. Why risk-off? Because the US stock indices sold off. And what's interesting over here is that the sold-off or the bearish reaction reacted off exactly very close to the key short-term pivotal resistance that we highlighted last week for those who actually followed me in my daily dose of market insights. So later I'll recap on that short-term key technical levels again on the benchmark US stock indices. And also this risk off in the benchmark US indices has been more or less been related to geopolitical risk as well. The geopolitical risk premium has been rising out from the unfortunate events from Middle East, as we know that the Israel and the Hamas conflict has started to spread off to the wider Middle East region, where Iran may get, that's an indicative odds, a high odds that Iran may get involved, and that actually push up oil prices. So as you all know, that oil prices itself has a very strong positive relationship with inflation expectation. So as we know that inflation expectation starts to increase due to higher oil prices, they will actually keep the Federal Reserve to be less dovish next year. So that is pretty much also indicative of this rising US 10-year Treasury yield that has been pretty much intact since last 2 weeks. That means, i.e., overall, their medium-term uptrend still remains rather robust on the to see further potential upside. Okay, so now let's very quickly look at this status. Then the dollar is also strengthening as well. Okay, on Friday, together with, very interestingly, together with gold. So later I'll touch on the chart of gold. What I see over here is that spot gold XAU/USD managed to see a squeeze up above a key medium-term resistance level, which is the 50-day moving average. So that actually indicate to us that gold right now is more behaving like a safe haven asset rather than a risk of holding gold due to the higher opportunity cost. That means, i.e., the negative impact of higher opportunity cost of holding gold has been negated, more or less been, we call it, offset by this high, safe haven play for gold. Okay, now very quickly, let me share with you the heat map of the S&P 500. Okay, so this is the heat map of the S&P 500. Okay, so let me hide myself for a while so that you all can see the screen much better. Yeah. Good. So what I could see over here is that the rising US 10-year Treasury yield has been took a toll on the, for sure, the more sensitive growth and technology sector. So they actually underperformed on last Friday. So that actually led the Nasdaq 100 to be down negative 1.24%, the S&P negative 0.5%, the Russell 2000 a negative 0.84%, and the one that is slightly positive is the Dow Jones Industrial Average. Why? Because it has certain weightage on the healthcare, which is a defensive sector, which is that led the Dow Jones to outperform the benchmark US stock indices on last Friday with a slight marginal gain only of positive 0.12%. So no clear signs of a a bullish reversal in the Dow Jones Industrial Average. So all in all, the banks are pretty much sideways over here. You can see over here is that yeah, so talk about the banks over here. So very quickly, right? U.S. banks actually report their earnings on last Friday. JPMorgan, Citi, and Wells Fargo. So they actually beat expectation. But what the situation right now over here is their senior management start to actually give a very lackluster guidance, indicating that there are many difficulties ahead. So this was the big boss of JP Morgan actually warned. So that actually lead to what I call a show-off in the entire banking sector, the US banking sector. So to have a technical gauge, right, or a sentiment feel of how to look at things in the banking sector, we could look at the technical analysis of the broader base US banks ETF. That means we're talking about banks ETF, that means combination of big banks, small bank, and the major banks. That means KBE in short, the ticker code. So let's very quickly, right, look at this ticker code again. Okay, previously I shared with all this ticker code. So what you can see over here is that very lackluster in the bank's performance of the based on technical analysis chart of this KBE. This is a weekly chart. This dotted line over here, this huge plunge was actually caused by the regional banks turmoil. Over here is that still recall that the potential bank run in the small and medium bank, Silicon Valley Bank is one of them. So what we could see is that yesterday's last week price action was rather lackluster, tested a key short-term resistance, can't break above it at 37.55 and start to plunge downwards. If you look at the daily on Friday itself, it also ended a rather bearish candlestick with a high volume. So very clearly indicating to us that despite the strong earnings beat by JP Morgan, Citibank, and Wells Fargo on last Friday, because due to the lackluster earnings guidance from their lackluster future guidance, I would say the future performance, as stated by the senior management, that causes a negative feedback loop into the entire banking sector. So if the entire banking sector continues its medium-term downtrend that is in place since middle of July this year, there's very low odds that we may start to see the start of a medium-term uptrend in the benchmark US stock indices. So that's what's we implying on the banks, the US banks, yeah, right after the key banks earnings announcement on last Friday. Okay, now going forward, economic indicator. All right, so now let's take a look at the economic indicator. One of the key indicators is that, as you all know, that US economy is pretty much driven by the services sector and consumer spending. Michigan consumer sentiment, that means compiled by the University of Michigan. This is the flash data for October. So about 2 weeks from now, they will come the finalized data. But the flash one also came in pretty lackluster, 63. So way below expectation of 67.2. And you look at the trend right now, it's actually the third consecutive month of expectation slowdown since the high of the summer that is close to summer. So what we could see over here is that US consumer is getting lesser and lesser upbeat due to the fact that it could be related to higher oil prices, or it could be related to what I call they start to feel that the liquidity crunch in US itself, or the tightening of the liquidity situation in US, they're able to get less access to banks, we call it credit. So that could actually, we call it, give this kind of lackluster downbeat mood in consumer sentiment. But most importantly, it actually declined down to a 5-month low. So with that, that is also not a rather positive sign in terms for the sentiment for risk on sentiment for risk assets like equities. Okay, so that is for the key data on Friday. And right today morning over here, what we have again on Monday today is that is the PBoC. So PBoC actually right today the announcement came in pretty early because there's no exact time they will actually choose to announce their one. This is one of their benchmark interest rate. Is called a 1-year medium-term lending facility, where banks in China are allowed to borrow from the central bank. It's a one year. We call it a bank term lending facility from the central bank. So the PBoC from China, the China central bank, keep this rate unchanged at 2.5%. So very likelihood, right? The one that is going to announce on Friday, because on Friday there will be, later this week there will be this. Okay, let me share what we have this week. In terms of the calendar. So unchanged at 2.5%. So let's immediately go to this week calendar. Okay, because usually after this 1 year MFF is being announced, towards the later part of the week, the Chinese central bank will also announce this. Okay, where is it? I think it's on Friday. Yeah, this loan prime rate, 1 year loan prime rate, and 5 year loan prime rate. So these are actually another key interest rate benchmark for China. So this loan prime rate is actually an 1 year and 5 year is tied to home mortgages and as well as business and consumer loans. So very likely these two rates will remain unchanged at 3.45% and 4.2%, given the fact that today's the 1 year MFL rate is unchanged as well. So with that unchanged in rate, very interestingly, if you look at the Chinese CNH, the dollar against the offshore Chinese yuan is still being trapped inside this sideways range of 7.3165 and 7.2720. Okay, still ranging between these two range since the second week of September. So it's about close to a month already. It risen much above this ratio. All in all, right, what you could see right now over here is potentially, right, there is a bit of indirect kind of intervention coming into the FX market by PBoC to prevent the Chinese yuan from weakening too much against the dollar, despite the fact that the dollar now has started to weaken against the other major currency. Okay, so going forward, right, before we jump into the short-term technical outlook chart, what are the key data to look out for today? Let's very quickly go to the calendar again. Okay, so for today, right, Monday, let's look at the European session. So over at the European session over here, there are a couple of two European ECB central bank speeches, official speeches at 3:30 p.m. and 4 p.m. Singapore time. These are the two ECB officials that will actually start to speak that may impact the FX market. And throughout the rest of the session over here is rather a quiet aspect for US. There's no key economic data out for US except the fact that we have a Fed official Harker speech later at 10:30 p.m. Singapore time. All right. So with that, that pretty much sum up for the economic data side of the story and event side of the story. So for today, right, is also a US earnings announcement. So US earnings today, there's no key much data. The big one will be on Tuesday, where the other two major banks will start. I would say financial institution will start to release their results on Tuesday before the start of the US session. Will be Bank of America and Goldman Sachs. Okay. Then now that's for Tuesday before the start of the US session. So now let's go to the FX market first. So I could see this is the rolling 1 month performance as of 16th of October, which is today. Yes, dollar start to see a very strong rally on Friday. Right now you see a bit of a dollar pullback across the board. What we could say after that strong rally in the US session, throughout the US session on last Friday. So let's take a look at the technical outlook again on the starting off with the euro dollar first. So on the euro dollar over here, if you look at the euro dollar, euro versus the dollar, this is a 1 hour chart. Price action going to inch downwards and now retesting the 6th of October swing low area at 1.0490. So on last Friday, we do have a bearish bias condition again due to the fact that it failed to break above 1.635 on last Thursday. So with that, we're still maintaining that short-term bearish bias on the euro dollar trading below the 20-day MA. So we're using a tightened key short-term pivotal resistance for today to maintain that short-term bearish bias will be right now at 1.095. We're so confluence with the 20-day moving average as well. Looking for a breakdown of 1.0490 to expose the next resistance at 1.045 level, which is the swing low area of 3rd of October, then thereafter followed by 0.42. However, if we start to see a breakout with hourly close above 1.059, then it will start to evolve a very choppy movement to retest last Thursday swing high area at 1.0635. So that's for the euro dollar. So for the sterling dollar over here, the sterling dollar going to inch much down, much lower as well, coming very close to the support level that we highlighted on last Friday, 1.2110. So you recall on last Friday, we also flipped to a short-term bearish bias on the sterling dollar. So we will maintain that short-term bearish bias for today as well, with a tightened key short-term pivotal resistance right slightly above the 20-day moving average as well, I think as a resistance at 1.2240. So as long as 1.2240 is not surpassed to the upside, we will maintain this short-term bearish bias on the sterling dollar. Breakdown below 1.2110 exposes the next support level at 120.50. However, if we start to see a clearance with hourly close above 1.2240, then it will start to invalidate the short-term bearish bias to see a choppy up move to retest the last Wednesday and Thursday swing high area at 1.2330. That's for the sterling dollar. Now, very interestingly, on the dollar CAD over here, so I could see on the dollar CAD over here is that last week's squeeze up actually stopped at this bunch of minor swing high, minor swing low, turns into a pullback resistance. And what's interesting over here is that if we do the PBoC retracement, it stopped exactly at the 61.8%. And bear in mind that over here is that the Canada dollar has a strong, I would say a significant direct correlation with oil price. That means higher oil prices will lead to a potential strengthening of the CAD. That means dollar CAD rate will be more likely inching downwards towards the downside rather than the upside, given the strength of the oil prices that was pretty much resilient in last week as well, due to the geopolitical risk premium that is increasing, that I explained earlier at the start of my daily market dose for today. So I'll be using 1.3695 as my key short-term pivotal resistance, looking for a further push down to at least retest the 20-day moving average, acting as a support, which is confluence with the minor swing low of 10th of October, 11th of October, and as well as 12th of October at 1.3580. But however, if we start to see a breakup above 1.3695, then with an hourly close above it, that means we start to see a further push up to retest this long-term major range resistance at 135.40. Why I say this 1.3540 is a major range resistance. If you flip to the daily chart over here, so what we could see over here is that this 1.3540 has been capped since the high. This major range resistance now at 1.3540 has been capped previous up move of the dollar CAD since 13th of October 2022, not this year, 2022. Okay, so it's been about a 1 year range for the dollar CAD has been trading between below this 1.3540, below this major range resistance, now acting as a resistance at 1.3540. Okay, so that's for the dollar CAD. Having this short-term bearish bias for today, holding below 1.3695 key short-term pivotal resistance. Okay, so very quickly on the dollar yen. So dollar yen no change, kind of trading sideways for the last Friday, still holding above our key short-term pivotal support level that we have on Friday to maintain that short-term bullish bias condition 14907. So as long as this level holds, potentially you could see a test to 150.30, which is pretty much close to the psychological level, and as well as there's a risk of what I call more heightened, we call it verbal intervention up from MOF to actually stem Ministry of Finance of Japan to stem this further rise, further yen weakness against the dollar. But however, we start to see a breakdown below 14907, an hourly close below it, which is all the 20-day moving average closing below 1 hour close below this 14907. Then this short-term bullish bias condition will be invalidated to see a slide down to retest this minor range support at 14825 for the dollar yen. All right, so what's interesting over here is that given the recent push up in the recent rise in the geopolitical risk tension, if we will to look at the situation over here, is that the CNH, right, the CFH, the CHF, the Swiss franc has been pretty much of a safe haven play as well. So if you look at the Swiss franc over here, the dollar didn't strengthening much against the Swiss franc. It actually collapsed again on last Friday. So the Swiss itself seems to be offering as a safe haven play rather than the Japanese yen, because the Japanese yen is due to that fact of currently there is still more less hawkish BOJ that is still unreluctant to give any clear signs of when they were going to start to normalize their negative interest rate policy. So if we were to look at a cross play called the Swiss yen, so Swiss yen, this this cross play was featured last week as one of my daily market dose insights. You could recall, I think last Tuesday or Wednesday, last Tuesday if I'm not wrong. So previously we have a resistance level at 165.60. We do have a bullish bias condition on the Swiss yen in the short term. So this level has been met already. Okay, and it did a pullback on last Thursday. So with that, right, the outlook still remains bullish on the Swiss yen in the short term. So I'll be using a Titan key short-term pivotal support for today for the Swiss yen to take advantage of this potential ongoing Swiss safe haven play, 164.75 key short-term pivotal support level, which is right at the above the 50-day moving average. Looking for at least some kind of potential pullback close to 165.20. So as long as 164.75 short-term pivotal resistance not surpassed, potentially the Swiss yen could retest the 22nd and 30th of August swing high area, swing high resistance at 166.60. However, if we start to see a breakdown below 164.75, hourly close below it, then this current push up will start to see a much more substantial retracement to retest the next support level at 164.10/163.60, which is also the 20-day moving average. Okay, so now very immediately, let's quickly go to the benchmark US indices. Benchmark US indices over here. Let's start with the Dow Jones first. So for the US Dow Jones Industrial Average, US Wall Street 30, we call in our platform, kind of sideways level, holding below the key short-term pivotal resistance at 33,935 that we had for last Friday. Still no change. Price action still remains below the 200-day and the 50-day, 20-day moving average on towards the end of the US session on last Friday. So still maintaining that 33,935 key short-term pivotal resistance level. A break below 33,510 will start to see potentially trigger a further slide to test the next support at 33,160. However, if we start to see an hourly close, a clearance with hourly close above 33,935, then potentially we could start to see a squeeze up to test the 50-day moving average, now acting as a resistance as well at 34,370. So that's for the US Wall Street 30. The Nasdaq 100, so Nasdaq 100 slide down as expected, almost test the support level that we highlighted earlier at 14,920, which is the 20-day moving average, and before prices start to retrace up again, and now intending to actually inch down lower right at the 50-day moving average, acting as a resistance, which is at 15,100. So I don't want to use a 15,100 level to be so tight because the US session hasn't opened yet. So I'll be using yesterday's last Friday, pardon me, not yesterday, about tongue twist. Last Friday's swing high area, we saw a previous key congestion zone level at 15,240 as my Titan key short-term pivotal resistance for today. Looking for a test down towards the intermediate support level at 14,920. Breakdown below it exposes the next near-term support level at 14,825. However, if we see an hourly close above 15,240, then this short-term bearish bias condition will be invalidated to see a squeeze up to retest last Thursday's swing high area at 15,355. We also confluence with the medium-term descending trend line from 19th of July 2023 high. Okay, German 30. Continue to inch downwards over here. So I'll be still using this 15,410 as a key short-term pivotal resistance, which is slightly above the 20-day moving average. So as long as this level is not surpassed, potentially the German 30 could see a further slide to retest 15,045, followed by 14,930, which is close to the swing low area of 4th of October. However, if we start to see a break up with an hourly close above 15,410, then this short-term bearish bias condition will be invalidated to see a retest on last Thursday's swing high at 15,610/15,000. 15,560/15,630, which is also the 200-day moving average acting as a resistance. Okay, so very quickly, Hang Seng, which is the Hong Kong 33. Lastly, Hong Kong 33 managed to help above our key short-term pivotal support level that we have for last Friday, which is also the 20-day moving average. Can't break below it in today's Asia session at this time of my presentation. 17,680. That means clearly this is a key short-term pivotal support level. But I will use this area here, 17,880, which was last Wednesday minor swing low breakdown, turns into a pullback resistance level where the price action refused to break above this morning as well. So very close to the current intraday high that was seen right now during the Asia session for the Hong Kong 33 index. So this will be like a trigger level, upside trigger level. A clearance above 17,880 potentially could reinforce this short-term bullish bias that we have on last Friday, that I'm still maintaining it because it didn't break below 17,680 to see a further push up to retest 18,145 in first step, which is the 50-day moving average. But however, if we start to see a breakdown below this 17,680, that means an hourly close below it, below this level, that means then this short-term bullish bias condition will be invalidated for the Hong Kong 33 index to see a further squeeze down to retest this minor resistance and minor support congestion zone here at 17,430 level. Okay, so that's the next support level to watch on the Hong Kong 33 if 17,680 level is not able to hold. Okay, now in the commodity, so on the commodity over here, let me touch on WTI crude first. So WTI crude oil over here, what we could see is that last Friday we see a squeeze up over here at this point in time, and right now we start to see a kind of a bearish divergence that has been taking shape on the hourly RSI. So indicating to us there is a chance of a much more shorter term, steeper pullback level to pull it down towards this level here. Okay, which is at the 8630 level, which is close to the 50-day MA. So I'll be using this 8530 level as my key short-term pivotal support for any potential pullback to maintain this short-term bullish bias for a test at 8860, which is the 20-day moving average. Above it sees the next resistance level at 9030, 91 figure level, okay, which is this former swing low now turns into a pullback resistance. And if you do the PBoC retracement from the high of 28th of September all the way down to the 6th of October low, that's confluence with very closely to 61.8% PBoC retracement as well. Okay, so having this short-term bullish bias on WTI crude, but with the risk of at least a steeper pullback first to take shape first before the start of a new bullish, we call it new uptick in WTI crude. Why potential steeper short-term pullback? Because of this bearish divergence since in the hourly RSI. Okay, but however, if we start to see an hourly close below 8530, means the pullback went below 8530, then this short-term bullish bias condition will be validated to see a retest of 8320 level, which was last Friday low. Okay, now the next one which I will share with you all, very important, will be the gold price. So spot gold see a melt up yesterday. So what it did over here is that this melt up broke above this former descending trend line resistance, descending channel resistance that is in place since 4th of May. Okay, so indicating to us right now that yes, last Friday's push up could be the start of a more pronounced up move on the gold XAU/USD. That means we may start to see a start of a medium-term uptrend given the break of this medium-term descending channel previously that is in place since that kept previous upside since 4th of May. Okay, now going to the hourly chart over here, what we could see over here is that there's no bearish divergence, but except the fact that it hit a rather extreme overbought level and now started to exit from this overbought level, indicating to us there's a chance of at least a minor pullback towards this 1917, which was the breakout of that descending channel resistance, now taking a pullback support, and the 50-day moving average as well, now acting as a support at 1903. So I'll use the lower boundary level 1903 as my key short-term pivotal support for support level for today to hold any potential minor pullback. Then thereafter, potentially we'll start to see a further push up to test the next resistance level at 1949. This is the shorter, we call it the intermediate resistance level 1949, which close confluence very closely to the 1st of September and 21st of September swing high area. However, if we start to see a breakdown with an hourly close below 1903, then this minor pullback scenario will evolve into a steeper pullback scenario towards the next support level at 1880 level, pardon me, 1880 level, 1880 level, which is also the 20-day moving average, I think, as a support level as well. Okay, so that's pretty much sum up for today's daily dose of market insights and the key highlights that I'd like to share with you all. So with that, I wish you all a great day ahead and we shall speak again tomorrow. Thank you.